The major Wall Street banks have just revised their S&P 500 targets for 2026 sharply higher. Goldman Sachs has lifted their year-end target to 8,000. Morgan Stanley is at 7,800 for year-end and 8,300 by mid-2027. JPMorgan holds at 7,500 with a bull case of 9,000. Deutsche Bank sits at 8,000. Every one of them is leaning bullish, citing strong first quarter earnings, enterprise AI adoption, and positive operating leverage. I want to take that consensus apart because as of this morning, the S&P is sitting at 7,547. The market has already done the heavy lifting, and yet the risks confronting this market right now are the most serious I've seen. So what I'm presenting today is the Friar's research, independent assessment, built from the doctrine's own active positions, the Hormuz divergence model, and the hard data now coming out of the bond market. As Charlie Munger reminds us, the big money is in the waiting, not the trading. What I'm going to show you today is why the waiting right now is in the bear camp. The baseline, where we stand now. The S&P 500 is 7,547. That's a 27.5% gain year on year. The Nasdaq composite is at 26,993. Both indices hit all-time highs last week. Every major Wall Street bank has just revised its S&P 500 target upwards, and every single one of those revised targets is already at or below where the market is trading today, or offers only marginal additional upside. Goldman Sachs has raised its year-end target to 8,000, up from 7,600, citing stronger than expected Q1 corporate earnings. Morgan Stanley targets 7,800 for year-end and 8,300 by mid-2027, pointing to positive operating leverage and enterprise AI adoption. JPMorgan maintains 7,500 for year-end, but has flagged a bull case of 9,000 if AI productivity supercycle exceeds expectations. Well, shit, Fat Freddy's cat can tell you that. Deutsche Bank sits at 8,000, relying on earnings expansion beyond the mega-cap technology cohort. That is not a diverse set of views. That is a crowded consensus. And the market at 7,547 has already priced in much of it. There is perhaps 3 to 6% of upside to the mid-range consensus. That asymmetry, limited upside, substantial downside, is precisely the setup the doctrine is positioned for. But more importantly, this is where I disagree fundamentally with the institutional consensus. That target was modelled on 3 assumptions that are now under serious structural challenge. Diplomatic resolution of the Iran-Hormuz conflict, it's not happening. Iran, USA and Israel are not even close. They've agreed on a few, but the nuclear issue and controlling Hormuz has not been agreed to. They are totally opposite. Plus BB and it's not happening. Next, multiple Federal Reserve rate cuts in 2026 virtually eliminated from market pricing. In fact, the opposite. Yields will go up. Sustained AI-driven earnings growth justifying current multiples. Increasingly questioned as the CAPE index hits 41.6 times. When I built the Hormuz divergence model, the thesis was precisely this. The market price prices first-order victims while missing the C variable cascade. The bond market is now the C variable and it's starting to bite. Wall Street consensus versus the Friar's research. This slide puts the institutional consensus directly alongside Friar Tuck's research forecast, and the contrast is stark. Goldman Sachs, 8,000 year-end target raised from 7,600. Goldman has raised its year-end S&P 500 target to 8,000, citing stronger than expected corporate earnings in the first quarter reporting season. That's a 6% upgrade to their target. The rationale is entirely backward-looking. First quarter earnings were good, therefore H2 will be good. There is no acknowledgement of the bond market, the Hormuz disruption, nor the CAPE ratio. Goldman's call implicitly assumes the macro environment of Q1 2026 persists for the next 7 months. Friar's research view is that it will not. Morgan Stanley targets 7,800 by year end and 8,300 by mid-2027. Their thesis rests on two pillars: positive operating leverage as revenue grows faster than costs, and the financial benefits of enterprise AI adoption flowing through to earnings. I have no quarrel with the AI productivity argument in the long run. Structural thesis. The question is whether the market at CAPE index 41.6 times and with a 30-year treasury at 5.19 has already more than priced that in. Morgan Stanley's 7,800 target offers precisely 3.3% upside from where the S&P trades today. That's not a bull case, that's a rounding error. JPMorgan is the most intellectually honest of the four, and that's a rare case that I've ever said that. Their base case of 7,500 is actually slightly below current levels, an implicit acknowledgement that the easy money has already been made. Their analysts have also outlined a plausible bull case to 9,000, contingent on an AI productivity supercycle that exceeds current expectations, and I find that hard to believe. I have two observations. First, a base case target below spot is a remarkably cautious posture for a major sell-side firm, and it deserves attention. Second, the 9,000 bull case is conditional probability. It requires the supercycle to exceed already elevated expectations. That's a very high bar. Friar's research central case sits well below JPMorgan's base. Deutsche Bank remains one of Wall Street's most bullish houses with a year-end target of 8,000. Their differentiated argument is breadth. They are not relying solely on mega-cap technology. They expect robust earnings expansion from sectors beyond the Magnificent Seven: industrials, healthcare, and financials. That is a more nuanced bull thesis than Goldman's or Morgan Stanley's. Friar's response: breadth-driven earnings expansion requires a benign macro environment. Stagflation, a trapped Federal Reserve, and Hormuz-driven input cost pressure are not a benign macro environment. The sectors Deutsche cites, industrials, healthcare, are precisely the ones most exposed to the C variable cascade described in the Hormuz divergence model. Okay, Friar Tuck's research 12-month central estimate is S&P 500 in the range 5,800 to 6,200, a decline of 18 to 23% from current levels. This is not a contrarian position for its own sake. It is the output of four independent analytical pillars: valuation, interest rates, geopolitics, and doctrine signal alignment, all pointing in the same direction. The consensus is not wrong because it's the consensus. It's wrong in our assessment because it is modelling a macro environment that no longer exists. Valuation, a second dot-com peak. Okay, this slide's about the Shiller-Cape ratio, the cyclically adjusted price-to-earnings ratio developed by Nobel laureate Robert Shiller, who's at Yale University. Currently sits at 41.6 times. The long-run average since 1881 is 17.3 times. We are currently trading at 2.4 times the historical average. For historical context, this level has only ever been reached once in 140 years of US market data. At the dot-com peak in December 1999, when it reached 44.23, before the S&P 500 lost roughly half its value over the following 2.5 years. The current reading is substantially above the 1929 pre-crash level of 32 times and well above the 2007 pre-GFC peak of 27 times. Now, there is a legitimate bull argument here, and I want to be fair to it. Modern tech companies have more than durable earnings that the cyclical industrials that dominated earlier eras. Software margins are structurally higher. That may justify some of the premium above historical mean. But 41.6 times? I don't think so. That justifies an assumption of perpetual compounding earnings growth at a rate that has never been sustained historically. And it leaves essentially zero margin for error. Any earnings disappointment, any yield spike, any geopolitical shock further than what we've already got, and the mechanism of mean reversion begins. Standard price earnings analysis confirms this. The market is currently 76% overvalued versus the modern era average. A 34% decline from February 2025 levels would be required to generate historically normal long-term return. The bond market, the mechanism of destruction. This slide explains the transmission mechanism, how Hormuz war gets from the Strait of Hormuz to Friar's S&P 500 options position. Look at the yields. The 2-year Treasury is at 4.12, actually above the upper band, the Fed's own target range. The 10-year is at 4.56. The 30-year has hit 5.19, the highest level since before the global financial crisis of 2007-8. The CPI came in at 3.8% for April 2026. The consensus was expecting 2.7. That's not a miss, that's a different universe. Parallel, perhaps. The academic mechanism here is well established and it's worth walking through clearly. Gordon's dividend discount model and Damodaran's equity risk premium framework both rest on the same foundation. Equity valuations are the present value of future cash flows, discounted at the risk-free rate plus equity risk premium. When the risk-free rate rises, Thus, when the 30-year yield goes from 4.5 to 5.2%, the denominator expands and the present value shrinks. Think upcoming IPOs. Technology stocks are the most exposed class because they derive a disproportionate share of their value from earnings that are projected 10, 15, 20 years into the future. This is what academics call duration risk. Exactly the same concept as a long-dated bond. Nvidia, Microsoft, Palantir, these are effectively 30-year duration instruments masquerading as equities. And here is the compounding problem. Kevin Warsh has just taken over from Jerome Powell. The bond market is already pricing a 38% probability of a rate hike, not lower, higher, by December 2026. Friar would estimate perhaps the meeting before. The Fed is trapped between a supply shock inflation it cannot cure with rate policy and a market that desperately wants cuts. The long end of the yield curve has taken control. Peter Bokvar, the Chief Investment Officer of One Point Financial, put it perfectly. Long-end rates are now in control of monetary policy. So Friar says that is a structural shift, not a temporary blip. The Hormuz divergence model. This is the heart of Friar Tuck's macro thesis, and I want to explain why the active positions in the doctrine portfolio are not random. They are each a precisely calibrated expression of this model. The Hormuz divergence model has three core propositions. Markets price first-order tickers, oil majors, airlines, shipping, while missing the C variable cascade, the physical supply constraint mechanisms that take 3 to 9 months to propagate through the economy. Next, the disruption is structural, not episodic. The war is still going. The two sides are polar apart. Every week it continues the conflict for another week. Oil is around $100. Another input cost shock, another CPI surprise. And the downstream effects are asymmetric. Commodities, precious metals, energy and agriculture inputs benefit. High multiple growth equities are destroyed by the rate consequences. Look at the left column. That is the supply shock cascade running from Hormuz disruption through to tech valuation destruction. This is not a theory, this is what the data is showing us right now. Now look at the right column, the doctrine's active positions. Every single bear position, QQQ, Palantir, EWJ, the Japanese index, the Korean index is looking for an entry, SOX is looking for an entry, is a defined risk expression of the macro thesis. Every bull position, gold, silver, USO, and DBA, which is an agricultural ETF, is the mirror image, long real assets and commodities that benefit from exactly the same forces that destroy growth equity multiples. This is the doctrine working as designed. You don't need to be right about every trade when the structural thesis is coherent and all the positions hang together on the same latticework of theory, to use Charlie Munger's phrase. Well said, Charlie. Scenario matrix and targets. Okay, Friar's research has decided on some probability weightings and provided the reasoning behind each. So firstly, the bear base case, 50% probability. The S&P finishing the year 5,800 to 6,200. Nasdaq 18,500 to 20,000. This is Friar's central case. Stagflation persists. The Fed cannot cut. The war continues. Tech multiples compress as the 30-year yield stays elevated. This is not a crash, it is a steady, grinding cyclical bear market within a secular bull. Not to say there won't be a sudden spike down. A 15% to 22% decline on the S&P from current levels. A deep bear, 25% probability. A 25% probability is not negligible. It is 1 out of 4. The trigger here is escalation, a physical Hormuz closure rather than a partial disruption. A credit market event. Remember Silicon Valley Bank? These things can emerge quickly. Or the beginning of a genuine CAPE index mean reversion, where the multiple compression becomes self-reinforcing. Next, a soft landing. The bull, 20% chance. S&P 7,500 to 8,000. Nasdaq 27 to 28,500. This is the Goldman Sachs Morgan Stanley scenario. It requires war resolution, rate cuts, and AI earnings beats simultaneously. It is possible. I assign 20% to it. The asymmetry of the payoff profile for bear positioning is therefore compelling. Black Swan, 5%, super bear. Full Hormuz closure. Confirmed US recession, banking stress. Low probability, but the defined risk structure of the doctrine means exposure to this outcome is capped. So Friar's weighted central estimate, S&P 500 will be approximately 5,900 to 6,400. Nasdaq 19,000 to 21,000. This is a decline of roughly 15 to 22% on the S&P and 20 to 28% on the Nasdaq from today's levels. This is consistent with a normal cyclical bear market within a secular bull. It is not the end of the world, but it is a different universe from the Wall Street consensus range of 7,500 to 8,000. Okay, we'll finish up with a clear structured framework rather than a set of disconnected data points. So first, Pillar 1, valuation. CAPE index 41.6 times is not a subtle overvaluation. It is the second highest reading in 140 years of US market history. The only comparable period ended in the S&P halving. That is the fundamental foundation. Pillar 2, rates and the bond market. The 30-year at 5.2%, a trapped Fed and rising rate hike probabilities. The academic mechanism is clear. Tech duration risk is maximum. Pillar 3, the Hormuz factor. The war's still going. It continues. The parties are at polar opposites on two particular points. The consensus has not priced prolonged disruption. With oil around $100, CPI at 3.8% and rising, PPI at 6%, these are not temporary noise, they are structural inputs. Pillar 4, doctrine alignment. The doctrine has already voted with its capital. QQQ bear leap, Palantir bear spread, the Japanese index long put, waiting for entry on the Korean long put, and SOX long put, waiting for entries. All active. Gold, silver, USO and DBA, which is an agricultural ETF, all expressing inflation commodity side of the same thesis. They're the calls. The signal stack is coherent. Now, what does it mean for day-to-day trading, it doesn't mean panic selling of equities or trading on unlimited short risk. Friar's doctrine never does that. It's defined risk, structured positions. It means we wait for the algo to flash for us. We wait for everything to be in line. For now, we are waiting, looking at the bear side. We will see. And finally, number 9, these are just the data sources used in case anyone has any interest in it. Okay, happy trading, happy days.